Let me just clarify a fallacy that's been present in the fixed income markets for a very long time, and we've been asked this question for the last 2 or 3 years. What we've seen in the last few tightening cycles by the Fed, that actually the EM asset class performs very, very well. I don't think people make that connection, and especially the investors right now. So I think, yes, so over the last 2 or 3 years, there was a lot of fear that when the Fed raises interest rates, what's going to happen, how will that fallout extend to the emerging markets. But I think now that people are comfortable that the Fed is on hold or is dovish, a lot of that has cleared the way for what we think should be a sustainable rally within emerging market fixed income. So just going back and, in the first place, it wasn't a threat that was believed to be in the first place. And now that it's out of the way, we think that the markets will have a sustainable run going forward. So it sets up the emerging market fixed income, the emerging market fixed income markets quite well for at least the medium term. I think this NIRP, or the negative interest rate policy that we see right now, and 2 of the largest central banks implementing this, it's basically a new policy tool as far as the markets are concerned. They really haven't seen this tool being implemented in the past, and hence the efficacy of this tool was in question up until a few months ago. Now what we're seeing is actually, combined with the dovish Fed, and negative interest rates both in Europe and in Japan, is fueling the emerging markets or the emerging market assets. And I think what we're seeing is money flowing out of Europe and Japan, and not really going into the US because of, as you mentioned, the dovishness of the Fed, and hence all that money via the carry trade coming into emerging markets. So that, I think, as we've seen evidence of that, first of all, in the emerging market fixed income side. I think we're going to see the next effect in the local currency debt side, and then ultimately making its way into the emerging market equities space. The GCC fixed income space has been structurally broken for a very, very long time. The space has been around for the last 8 to 10 years, but we haven't seen a lot of development. We've seen the market grow, but not really develop. What I mean by that is 70 to 80% of the issuers or the issuances in the market right now are either SOVs or sovereigns or quasi-sovereigns. And we haven't seen this get extended to sort of your even your big corporates and your SME. The other thing we haven't seen is issuances by some of the large sovereigns in this part of the world. So, for example, Saudi Arabia has never issued a debt instrument in the international markets. So, I think what we are seeing right now is, because of the different forces and a lot of things that have been spoken about at this conference also, we are seeing a sea change within the debt structure here, and what we will see is a lot more issuances out of Saudi if Saudi Arabia were to go first and establish a sovereign curve. There's in fact a sovereign that hasn't issued for the last 7 or 8 years that's going to issue today, and there's the banking sector in this part of the world is a little bit liquidity constrained because of low oil prices and low hydrocarbon prices in the region, and hence we have issuers who would normally go to banks for their borrowing purposes now actually look at the bond market as an alternate source of financing. So I think we are on the cusp of a structural change within the debt dynamics here. Historically, the biggest factor in this region was oil and the price of oil. But what we've seen is in the last 1 year, where oil prices have been depressed, a lot of the countries in this region have been forced to look for other avenues of revenues. And I think the success of finding other ways to generate revenue away from where oil prices are is going to be the key make or break factor for this region going forward.